Time to get in a very special voice. Neelkanth Mishra, Chief Economist, Axis Bank and Head Global Research at Axis Capital with us on the show. Neelkanth, always a pleasure to talk to you. Thank you for taking the time out.
Thank you, Neeraj. Thank you, Neeraj. Thank you, man.
No, the pleasure is entirely ours. How are you viewing the developments of the last 48 hours? And let's start off with the basic act of the tariffs that have been levied and some counter tariffs that have been levied by some countries, and how and India's plan about the same.
See, of the 12 countries slash groups like the European Union, which account for about 85% of US imports, 3 have said that they will contest slash retaliate. So that is Canada, China, and the European Union. Even within the European Union, I think, for example, Italy, Giorgia Meloni, who was the only European leader to attend Trump's inauguration, has said that we have to work with the US. The rest want to retaliate. But my sense is that the retaliatory measures will perhaps be serious only from China. And we have to see once the tomb sweeping weekend holiday is over, what exactly they come up with. And this is where I think the risks are, which is the second order effects. So while the Treasury Secretary Scott Bessent did say that immediately after the Rose Garden speech that countries should have patience, that these are just headline tariffs, that we are open to negotiation, and don't be in a hurry to slap second order, basically retaliatory measures. I think the concern will be that especially countries like China, where the duties are as high as 54%, may have no option but to devalue their currency. And the moment the devaluation of the currency starts to take effect, then I think things start going out of control. And frankly, to take a step back and just to lay down the framework instead of just responding to each of the steps that the Trump administration is taking, I think it's very important to understand what their objectives are and why are they doing what they are. And we can see 3 key objectives. The first is they do not want the US to pay the cost of maintaining the multilateral world order. And so the executive order actually explicitly states that they had started with bilateral deals in 1934. And after the Second World War, they tried to get the multilateral order working. The most favored nation status rates were set. And then they found that those rates were unfair to the US. And therefore, they are now going against it. And they are going to the bilateral world order. Now, when that starts to happen, all kinds of industrial policy measures now become fair game. And so export subsidies, currency devaluation, labor subsidies, and so several types of behavior will now come into action and which will make predictability very low. The second objective is they want to generate revenues out of this. So the tariffs announced the night before account for about $550 billion. Remember that they had only about $79-80 billion of revenues from tariffs in the previous year. Now they want to add about $550 billion, and in parallel, they want to offset this with tax cuts. So this by itself is also an objective. So even though eventually some of the tariffs will get negotiated down, like for example, I don't think they have any hope of being able to manufacture footwear or apparel and do it cheaper than India or Bangladesh or Vietnam. So those tariffs will get brought down. But I don't think they're going to give up on the desire to generate revenues out of giving access to the US consumer. And the third objective is that they think that the US dollar is far too strong because of the US dollar's reserve currency status. It tends to be excessively strong. It bears the burden of global uncertainty. So whenever the world used to be uncertain, the dollar would appreciate, and they want to move away from that because they think that it is becoming unsustainable. So when you see these 3 objectives, a lot of what they're saying and what they're trying to do starts to make sense. It is not justified economically. Even the decisions that they've taken in terms of how the rates have been decided, and they've been explicit about it. It's right there on the USTR website. It is like, trying to achieve bilateral trade balance, which anyone will tell you is not achievable. So in this context, what we should expect is continued uncertainty. Remember that even if the tariff receipts were to be converted into tax breaks for the U.S. consumer, the problem is that because of uncertainty, those will be saved, and therefore this is a fiscal contraction. In fact, on a ballpark estimate, one can safely say that 1 to 1.5% of world GDP growth can be at risk because investments get pushed out, because for another 6-9 months, companies will not be clear on what the eventual tariffs are going to be, what the eventual currency exchange rates are going to be, and therefore they will pull back on investments, and that itself will drive a slowdown. So I think we are headed for a period of sustained uncertainty, which is not very good for financial markets.
So Neelkanth, with an assumption that that's exactly how it plays out, and then uncertainty is the name of the game, what can economies and central banks of countries like India do? We have a central bank meeting next week. For now, the RBI and the government have put up their hand and say they want to support, but this, is it out of the blue for a country like India, which may not be exporting as much, but could be impacted by the collateral damage of global growth suffering? And how does India combat that?
So frankly, I don't see that. I mean, and on a relative basis, I think the economic risks to India are among the lowest that I can see. The only concern I have is on the markets, because frankly, the markets are what are much, much more integrated to the world than our economy is. So I will not reiterate what I'm sure every guest that you had over the last 2 days would have told you, that exports to the US as a percentage of India's GDP is very low. In fact, our estimate is that the additional duties will cost about $10 billion to India or Indian exporters, and the US consumer will have to bear almost 60% of that. Basically, don't assume that all of these $550 billion will be paid by the exporting country, because many of these prices will get passed on, and therefore the US consumer will be paying the burden. So if you adjust for that, there's like a 0.1% impact on the Indian economy. In fact, on the medium-term basis, if Vietnam is not able to bring down its tariffs, a lot of electronics assembly, a lot of apparel assembly can actually start shifting to India as well. So frankly, economically, I think there is less of a risk. What has also happened, and thankfully so, that the drivers of India's economic slowdown in the last year, which were fiscal, regulatory, and monetary, the fiscal is, I think, less of a headwind than it was. Like last year, we saw 80 basis points of fiscal deficit decline. In FY26, we are going to see only about 40 basis points. So it's less of a headwind. Regulators have, financial regulators, I mean, there are new ones in place. They're saying that we don't want to be impediments to growth, and regulatory easing has started. And on the monetary side, the biggest problem was that liquidity was unduly tight for 16 months. The gap between the certificates of deposit, which effectively mark the rates on the certificates of deposit, which effectively mark the cost of funding for financial firms, for banks, were 150, 200 basis points higher than what the OIS, basically the repo rate was. And so that was primarily because of tight liquidity. I think in the last 2-3 months, we have seen the RBI act very forcefully, very decisively, and now has replenished the liquidity that was lost because of currency interventions. So the CD rates have started to come off. It is, I think, reasonable to expect that that over the next 2 months, the deposit rates will also start to come off, and then finally the credit easing cycle will take off. I think in the MPC meeting next week, the consensus is, frankly, I'm still worried about inflation, but I think the Overton window for the MPC is very narrow now. They are very likely, I think, to cut rates again. The repo rate comes down to 6%. So some of the self-inflicted growth slowdown is now starting to reverse. And therefore, economically, I see less to worry about. I'm more worried about what happens to the financial markets, because the equity risk premium, despite all the economic uncertainty we've discussed, is still near historic lows in India and the world. India's P premium is low, but the P multiples globally are also still elevated. I also see a risk of sometime in the next 3 to 6 months, the Chinese currency coming under pressure. And that will create new types of policy headaches for everyone. And of course, then there is the global growth slowdown, which I don't think we can be totally immune to, given that we do have some exposure through our exporters to IT services companies and, of course, global commodity prices.
Understood. Fairly detailed in that sense. Neelkanth, Harsh also joining in. You've mentioned the Chinese currency risk a couple of times. Contextualize that for us and our viewers.
No, that's it. Thank you for asking that. Get ready for another long answer. So, for a country that has a $1 trillion goods trade surplus and has maintained a current account surplus for most of the last 3 decades, people will find it surprising that the balance of payments in China are under stress. Is under stress, and I think that there are good reasons for that. The first is that their net international investment position, so how much of global assets they own and what are their minus what their global liabilities are, is only about $2.4 trillion. So this is only about 12-13% of GDP. What is even more worrying is that, and this is partly because a lot of the current account surplus they booked over the past 2 decades has been lost because of capital flight. So just in the last 10 years, the errors and omissions in the balance of payments, which is a measure of timing differences, has and should cumulatively be zero, is actually $1.4 trillion. So that's at least the amount that they've lost because of capital flight. So and therefore the earnings that they have on all of the past savings are actually less than the cost that they have to pay on their foreign liabilities, and their primary income is actually negative. So as we all know, they also have a negative services trade balance. So they have a lot of outgoing tourists. They have a number of students that study abroad. And so when you combine all of this, their current account is actually not as good as you would think it is. But I think the biggest challenges for them are on the capital account. Today, their net FDI is minus $200 billion because inbound FDI has more or less stalled and I think will remain weak for a while. Outbound FDI needs to be high and has been high. So in order to sidestep some of the retaliatory actions against China, and just the US, but if the Chinese start dumping into other markets, I think this will the barriers will start getting erecting in other economies as well. They have to do a lot of outbound FDI. This is exactly what Japan did after the mid-80s, where it started to invest in factories outside Japan. China needs to do the same to protect its market shares. What is even more important is that their 1.7-1.8% yield on the 10-year bond is far lower than what you see even in the developed market. So therefore, in the last 12 months, the 12 months ending September, their trade credit outgo was like $200 billion. So on the balance of payment side, they actually have a negative balance of payments. The reason why they are, I think, preventing the RMB for depreciating is that, like what we saw in India, when we move from a fixed exchange rate to a volatile exchange rate, there is a very sudden shortage of dollars, which is exactly what India went through. And I think in China also they will go through that, where exporters suddenly stop their supply of dollars because they think the currency is weakening. The importers try to start to hedge when earlier they were not hedging. And when you put all of this together, it creates temporarily a lot of pressure on the currency. Now, the problem is, if because of these tariffs, the trade surplus itself shrinks by $200-300 billion, imagine how much the pressure on the balance of payments is going to be. So they may not be doing it immediately, but when they see that this is inevitable, I think there will be a lot of volatility in the currency markets.
Okay, point taken. And how should one look at, and one on the global macro, one on the domestic macro, and therefore, sir, explain to us. One is you've already seen a 0.25% cut on the repo. You're expecting one more rate cut next week. How quickly does this start to translate on Indian lenders as well as consumption? So on both of those, you're already starting to see that in terms of certificate of deposit, etc. But true translation or true transmission will happen when deposit rates and loan rates start to change. How quickly do you think that happens?
That starts to happen in a couple of months. So see, already the 12-month CD rate, which was at 1.760 for a certain type of borrower, has fallen to 710. There are people who expect it can actually fall to 675. There are some extreme cases where people think it can fall to 650. Let's see what happens. But the point is that the spread, see the OIS, the overnight index swap, which is effectively the average expected rate of the repo rate over the next 12 months, when it was 610, 611, the CD rate was 760. So there was a 150 basis point gap. And for some of the smaller banks, it's actually 8% plus. That 150 should actually be 60, 70 if the normal liquidity conditions prevail. And so if the repo rate is at 6 and the 1 year OIS is at say 590, and so then I think 650 on the 10 years, the 1 year's 12-month CD does not seem that irrational. I'm not sure it will fall that fast, but it may. And so as that happens, the marginal cost of funding for all banks starts to come down significantly. And I won't be surprised if in the next week or so, maybe immediately after the MPC meeting, we start to hear of deposit rate cuts. So as that happens, the weighted average, so the MCLR then starts to fall. The weighted average cost of financing for the banks falls. And then given that credit growth has slowed so sharply, there will be products which are very rate sensitive, say like mortgages, where the banks will start cutting rates. And so I think in a few months, we should start to see the transmission happen. Frankly, just 2 months back, I would not have expected that because liquidity conditions were so excessively tight. But courtesy the significant interventions by the RBI in terms of large amounts of OMOs and very significant amounts of buy-sell swaps, they have more than offset the 5 lakh crores of liquidity they had been forced to suck out when they sold dollars. So this decisive action by the RBI, in addition to, I think, when the RBI dividend gets paid in end of May, durable liquidity can actually go to 2% of NDTL, which I think will be a very healthy level. What we are also seeing, and this is very comforting, that at one point, the RBI had an $80 billion forward short position on the dollar. Now, think about a bank which is looking at those numbers, and as of end of February, and you're worried that there's also an NDF short, which is not visible there. And what if the RBI is forced to sell more dollars and then the liquidity dries up again?
Right.
How can I sort of grow my lending? But now what has happened is that it looks like NDF shorts are now like $10-12 billion. From what currency traders estimate, the 80 billion forward short is now 60 billion of forward short. And so when you put all of this together, there is sufficient comfort that banks can take, and therefore they can start growing their credit book, which is actually very supportive for the Indian economic momentum.
Touchwood. So economy is relatively unscathed. I heard you say twice that you're worried about the markets. I'm guessing collateral damage in addition to growth could be the issue as well, even if the economy grows per se. But what could turn this, Neelkanth? I mean, is it renegotiation by various nations, including India, and therefore global growth not suffering as much? Because the sideshow of a lower crude price, lower DXY, all of that should be net positive. So what can turn Neelkanth Mishra's stance? Is it the solution to the trade talks, or is it something else?
Well, my stance, I'm an observer.
Okay, observation. Let's put it that way.
So okay, I'll tell you what the signals that I'm looking for. So you're absolutely right. I don't think so. These are very large costs. While, as we discussed earlier, the Trump presidency interprets its electoral verdict as sort of breaking apart the current system, which was not working for the US, is their interpretation. And therefore, I think they want to sort of build a new system. Now, in doing so, they seem to be doing things in a very haphazard way. So the question to ask is, what can force them to pull back from all of this seemingly random destruction? And it has to be like it's a democracy. I think there are some voices of discontent which have started to emerge in the Congress, for example, against these tariffs. Remember that it will be his party first which has to start putting this pressure. As of now, everyone is aligned. They all know that if the president supports them, they can get re-elected and so on and so forth. But as the economy weakens, I think popular support, and this is how democracies function, that there will be a feedback loop that starts to get generated, and then corrective actions can start happening. So we have to wait to see, the popular support for the president start to turn, because the pain then starts to become very real. Remember that he's also trying to address some of these concerns, like, for example, if, say, prices for some products go up, but he's going to position it as the cost of bringing manufacturing back to the US. He's also pressured the OPEC to increase oil output so that fuel prices at the pump, which are a very important signal for inflation expectations in the US, actually come down, which frankly will benefit us as well. But these are things that they will keep doing. There are other items on their agenda on how to bring down debt to GDP, how to weaken the dollar, and so all of these, I think, will be coming into play. The corrections start to happen. The uncertainty starts to erode only once the popular support for the president starts to come down, and that means real economic pain on the ground in the US. What I'm most worried about is that it is somewhat easy to break apart current system where there was multilateral agreement, where people had over decades after Bretton Woods, but even after Bretton Woods in 45, it took 12, 13 years for the Bretton Woods agreements to get implemented. There have been flaws, there are problems, but at least there was a collective decision to behave. Once you break that apart, I think reassembling that becomes a significant issue. So it'll be very challenging. I'm hoping it doesn't go that bad, but it is reasonable to expect that things will worsen a lot before they get better. The only thing I worry about from the perspective of equity markets is that the equity risk premium, which needs to be at a certain level, because equities are a risky asset class, are at historic lows when economic uncertainty is at historic highs. And so that it's not a modeled variable. So equity risk premium is a discovered variable. It is when some investor just gives up. I mean, look at what happened to pharma today, right? I mean, yesterday I felt that pharma makes no sense for the US to impose duties because most of the value of pharma is IP. Manufacturing, it does not really make sense where you do it. I mean, generics companies, sell for 20 cents and it's sold at $7 in the US. The point is, he still wants to impose those duties. And so eventually investors will get fatigued, tired, saying that, look, we can't predict this behavior and therefore we are kind of pulling back. And that's what worries me, that I think that's where there is a disconnect, and the price to earnings multiples we are used to need to be revised down.
Yeah, so well said. It's in simple terms, maybe just the uncertainty will take its toll more than anything else or unpredictability of what Donald Trump does. So well put. Neelkanth Mishra, well, thank you so much for all of these insights. Just absolutely lovely talking to you today.
Yeah, thank you. Thank you.